All right, welcome back to the videos. Hope everyone is having a great day. Let's talk about, this has just been on my mind because I've been reading Lights Out, which is about GE and its fall from grace. And let's talk about sort of the dispersion between reported profits, EPS, and cash flow. Okay. So in their situation, like a lot of companies that fail, EPS always looks a lot better than cash flow. It's a very similar situation with Enron as well. So what are your thoughts on that? Is that something that you always keep an eye out for? And like, you know, sort of that creative accounting, you know, and do you use cash flow as really a measure for legitimacy, and how you typically think about that?
So I usually look at balance sheet, then cash flow statement, then income in terms of which I care the most about. I use free cash flow as my measure of earnings. So what I'm actually detecting is the earnings having a difference from cash flow, in a sense. I'm looking at the earnings as a check on cash flow, not the other way around, and trying to figure out why is their earnings different. Most people, I think, are looking at like earnings. Not most people. Some value investors focus on cash flow too.
Yeah.
But they're like saying, oh, the company earned $2.40, and then they're like, oh, but the quality of the earnings isn't that good. To me, I'm like, the company has $1.80 in free cash flow, and then only then really worrying about the net income. The truth is, in most cases, it's not like I needed that to detect the problem. Usually when a company has those sorts of issues, there's more unusual stuff going on in the accounting and stuff. So like GE had these long-term service contracts. So that's something that stands out to you that you're like confused by. What does this mean?
Yeah.
Right. So, I mean, Enron, same sort of thing. Like, how are they making the money? You know?
Okay, so what's your version of free cash flow too? Because people always ask this. Is it EBITDA minus?
It's cash flow from operations less.
The most conservative way, pretty much.
Usually, yeah. So it's cash flow from operations less actual CapEx whenever possible. Now, sometimes the company is clearly spending a lot to grow, and then you might have to adjust it for that reason. And sometimes the company might be using up, the big thing to be cautious about is if the company is shrinking or something, it could produce more it could produce more cash flow than it appears to. Normal.
So the quality
cases.
Of that cash flow.
The quality, But you just figure out where's it coming from, working capital or things like that. If you want to do another check, what people do is usually EBITDA minus maintenance CapEx, EBITDA minus CapEx or something is a good way of doing it.
Yeah, because we looked at some like retailers, for example, where they produce a ton of cash, but it's like they're liquidating a lot of their inventory.
Right. Yeah. So like a declining one would be like that, and then a rapidly growing retailer, remember, doesn't produce a lot of free cash flow.
Yeah.
It keeps putting into more and more inventory and things like that. Yeah.
Okay. So I mean, what about companies that generate sources of float? Because that could come up in the difference between cash flow and net income.
That's a debate too. I mean, it's cash flow. They have it, and if they're going to grow over time, they continue to have it. A lot of companies don't use it aggressively though, which is the difference with like Buffett and them.
Yeah.
So yes, it's a big difference. We've looked at some companies that own some companies. If Warren Buffett owned them, they would compound faster because he would say, this is cash. You know, cash is cash, and I get to use this cash for more stuff that I can do. I'm not going to have it all sitting in a bank account or something. I'm going to go out and use this. You know, you could. He would feel you can offset all of your deferred revenue and things like that. Your basically your float can all be invested in like stocks and things like that. Sure.
So really, it's, I guess, doing a sanity check on the dispersion between net income and cash flow and seeing if it makes sense, right? Like, is that the nature of its business where they do have some sort of float? That's where the discrepancy is, or is there something like, you know, Enron or GE or whatever where it just doesn't make sense?
I would overwhelmingly analyze a business on the basis of cash flow unless you can't and you have to use earnings per share for some reason. And with like financial companies, you'll have to. You'll have to use their earnings as they report them. For some other companies that are aggressively spending on CapEx and stuff, you might have to. For very cyclical companies, you might get confused about it. But then you can use long-term averages and stuff. But I just analyze them using the balance sheet and the cash flow statement because I'm telling you, although Enron got like that expensive and stuff, I don't think a private buyer would have paid that for it. They would always have looked at the cash flows and stuff. Like, you know, think like private equity and stuff. They're not going to go buy something just because it has good EPS.
Yeah, we've talked about that before where the market was judging a company not great, but we're like, if this was your private business, you would just look at the cash flow. You wouldn't care about like the year-to-year earnings on it or anything like that. Cool. Well, this is On-Set Talks with Andrew and Geoff.
Okay.
Thank you so much for being a subscriber. Email me, focuscompounding@gmail.com, and we will answer any question that you have just like this. Thank you so much for all the support, and we will see you in the next video.